So the charts we picked to talk about this week really are sort of in line with what we've been talking about, and it has to do with the Fed, it has to do with inflation, it has to do with GDP growth, and sort of they're all sort of meeting together here at this critical point as we come into year end and start into next year. It looks as if, at least from some of the factors, inflation is sort of peaking right now, could be decelerating into next year. GDP growth is probably going to be decelerating in the mid to back half of next year. And the Fed could be actually tightening into those things happening, which generally is a bad thing. So we wanted to talk about that today as our topic. And maybe take us through what we're seeing here.
Yeah, we're looking at expected real GDP growth, expected median CPI, which is a measure of inflation. So those are the light blue and the green lines, respectively. And then also what the market now thinks the Fed is going to do in terms of raising the federal funds rate. And so what you see, the data that's in the past, those are actual numbers, and then all the data in the future, so Q4 2021 on, those are all expectations. And we see exactly what you just said. So you take these line by line. US real GDP growth at an annualized rate has probably peaked. Q4 is probably going to be the hottest print for at least the next 1 to 2 years.
And explain why that is.
Explaining that growth print and why that's going to be the hottest. That's primarily going to be due to base effects. And so the economy should slow as we normalize recovering from the pandemic out through next year to something that we're more used to, like 2 to 3%. And then the exact same thing as you were just saying, we hear inflation is super hot. It's expected that inflation should peak somewhere in Q1 of next year. And that's because of the year-over-year change in prices. And so the hotter inflation is now, the harder it is to get higher inflation prints in the future, because prices are so high now, you're going to have them grow at the same rate from those higher prices next year. And that usually doesn't happen. It's just how year-over-year comparisons work. It's called the base effect. Tough base effect. And so inflation should be slowing, peaking in Q1 of next year and then slowing as we get through mid-2022 and towards year end. And then those dark blue bars are what the Fed has talked themselves into. This is what the market now thinks, that the Fed is going to be pretty aggressively hiking interest rates as inflation and GDP are slowing.
And so why is that? First of all, why does the Fed always get that wrong? Like, why didn't they start hiking earlier?
Yeah, they're looking at backwards data. They said they wanted to, quote, wait until we saw the whites of inflation's eyes before they shot, is what they've been quoted as saying. And now here it is, it's staring them right in the face, and they feel compelled to act. And if you're looking at lagging data, inflation is very lagging. You want to know how the economy was doing a year ago, look at inflation now. Is basically what happens. And so they're reacting to the lagging data, and they fall into this trap every cycle, right? They end up overhiking right into the slowdown in the data that exacerbates the downturn, and then they have to pivot. And so what you see is this consistent behavior of over-promising in terms of rate hikes and under-delivering, because they're trying to hike rates as the data is slowing because they're late.
Do you think that the announcement that they're going to speed up the taper is sort of evidence that maybe they get it this time and they realize they've sort of missed their window, so they're going to try to catch up as fast as possible?
Yeah, definitely. It gives them a lot more flexibility. So you put the taper into perspective. Back early in 2020, we were talking about the taper would wrap up at the end of 2022. So that would mean the Fed's balance sheet would grow from $8.5 trillion now to something like 9.6. Then they came out and said, we're going to wrap up the taper mid-2022. That was the big adjustment. So now the terminal balance sheet goes from 9.6 to it should end around 9.1. And so going from June to March for wrapping up the taper, which is what they've said recently, it doesn't make a big difference in the size of the balance sheet. It takes it from a terminal balance sheet of 9.1 trillion to 8.9 trillion. What's 200 billion amongst friends? So the taper going from June to March doesn't really matter. It just gives them more flexibility because they don't want to be taking their foot off the gas while stepping on the brake, right? They want to have a clean handoff from the taper is complete. Now let's hike rates. So they clearly feel like they're now behind. The Army is marching upon them in terms of inflation, and they need to be ready to fight. So they want to wrap up that taper real fast.
So we could possibly see some rate hikes as early as March.
Yeah, that's started to get priced into markets. So that first blue bar, 18 basis points, so 0.18%, rate hikes you would expect would be 25 basis points. So the market is pricing in almost a full hike in March. The same meeting they wrap up the taper, they do the first interest rate hike. And then we get over 2 hikes by Q3 and then 3 hikes by the end of the year. So, that's probably wouldn't have predicted that the Fed would be talking themselves into this situation just 6-9 months ago, right? At the beginning of 2021, to think the Fed would talk themselves into having to deliver about 3 rate hikes next year, wouldn't have thought they would have put themselves in that situation.
Okay, so for the viewers, 3 rate hikes, what does that actually do to inflation, and then what does it do to growth?
Yeah. So this is the other pretty ironic thing. If you look at inflation, and you have to disentangle, is this a supply problem or a demand problem, right? We'd say, just to square the circle, let's just say it's half a supply problem. Well, raising interest rates does not help a supply problem. In fact, it makes the supply problem worse, because if you need more supply of goods that the prices are going up, you need more supply to be brought online, you need to incentivize investment in productive capacity to bring more supply online. And to incentivize investment, you keep interest rates below the rate of growth in the economy. So you can have excess capital flow to where it needs to go. So if this inflation they're seeing is primarily a supply issue, this is not going to help. At this point, the way the Fed can solve an inflation problem is by disincentivizing investment, bringing down the wealth effect, and reducing demand. And it's a very blunt-edged policy tool. Interest rate hikes, to think that that's going to solve the inflation problem is 75 basis points of federal funds rate hikes. It'll do something. It's just not very targeted. It's not very surgical. This is a very blunt instrument.
Yeah. So you made a comment about the wealth effect. That is clearly not something anybody has any interest in doing.
Right. Yeah. That's the other thing they're running into. We've said all along the Fed is going to hike in as much or taper as fast as the market lets them, because ultimately, wealth has never been higher, and balance sheets are very levered. Asset values on all balance sheets, corporations, individuals, et cetera, asset prices are very high. And if you raise interest rates too aggressively and it causes asset prices to go down, then people's balance sheets get inverted and you have a balance sheet recession. Whereas now your asset prices went down, but you don't get to write off liabilities for most people, right? And so you have negative equity, and that forces you to sell assets to pay your liabilities, which puts more downward pressure on assets. Look at what's happened to Japan for the past 30 years. So
it's not a good situation.
No, you don't want to get stuck in that downward spiral. So once again, to think that they would have talked themselves into this situation, definitely surprising, but we'll see what they do.
And perhaps explain how the rate hikes impact inflation in real terms, like food prices, home prices. Like, what is that going to do?
Yeah.
And how fast is it going to solve that inflation? Because even though inflation is rolling over, it's still going to be very high.
Yeah. It's really tough to say at this point. There's a lot of academic research that has come out to suggest that federal funds rate hikes, the way that they actually reduce inflation is by reducing demand so much that it puts the economy into recession. And then demand is so low and there's so much excess inventory that prices fall. That's not a productive way. That's not a soft landing type scenario. There's too much debt in the economy right now to negotiate a soft landing. Alan Greenspan was able to do that. We had a lot less debt back then. A lot less debt. It was much more maneuverable. But at this point, the economy is so sensitive to asset prices. Asset prices for many assets only make sense in a low interest rate environment. So those asset prices today are very sensitive to interest rates. And so, if the wealth effect were to fall and demand were to fall, yes, prices would go down.
Yeah. And I mean, wealth is the new growth, right? I mean, wealth is growth. And without wealth, I mean, how do you sort of take this forward? If wealth's going to be impacted, if you have to impact wealth, how do we recover from this type of scenario?
Yeah, ultimately they're going to need to pivot because the alternative, what you're talking about, a balance sheet recession where wealth is heavily impacted, it's just not in anybody's best interest. And it's not tenable. It's not tolerable. And so that's why you see the introduction of the Fed put and you see things like Fed pivots. So go back to 2018, for example. That was the last time the Fed talked themselves into this many rate hikes going forward. December 2018, and fall 2018, Jerome Powell said, we are far away from the neutral rate. Right. And asset prices, the S&P 500 went down about 19% going into Christmas, and immediately the Fed pivoted. Mm-hmm. And they ended up cutting rates the next year. The Fed knows the situation balance sheets are in. They know how elevated asset prices are. They will do this as long as the market allows them. And because asset prices are so high, the market probably won't allow too much of it.
So tipping point back half of next year, roughly?
So we can talk about how this might play out, because it doesn't necessarily have to be that something breaks for them to pivot. Okay. There could be a beautiful pivot. It's a low probability scenario.
I'd like to hear this.
Right? It's a low probability scenario. But if you were to get into a situation where growth was still very strong, labor market was making progress, but inflation tailed off much quicker than the Fed was expecting and normalized. What you could get is maybe a rate hike first half of next year and then a long pause, because there's just no impetus to keep hiking. Right. The labor market still would be healing. Economic growth is not too hot, not too cold, and inflation is coming right down into the Fed's wheelhouse. They've said they'd be willing to tolerate inflation over 2%, so let's see them tolerate it, right? And maybe they do one rate hike and they wait and see. Mm-hmm. That's sort of the best case scenario. What's more likely, in our view, and this is how it plays into our outlook next year, is if something's going to break, we want it to break soon. So you see the volatility flaring up, which we'll talk about next in November and December as the Fed signals a faster taper and potentially more rate hikes. If we get a 10 to 20% pullback early on before the damage has been done in terms of too many rate hikes, leaves plenty of time for the Fed to pivot. And you could actually have a really strong rally off of that into next year.